Imagine opening your eyes to a world where the fate of your wallet is determined not by your boss, your local politicians, or even the ups and downs of your own career, but by a select group of fewer than 24 individuals gathered behind closed doors in the heart of Washington, District of Columbia. These are not shadowy figures from a dystopian novel. They are the members of the Federal Open Market Committee, the policy-setting arm of the United States Federal Reserve, known simply as the Fed. Their decisions ripple outward, impacting how much you pay for your home, your car, your groceries, and even how secure your job feels each month. In June of the year 2025, the Fed made another pivotal decision. For the fourth consecutive meeting, it chose to keep its benchmark interest rate steady. On the surface, this might sound like a mere technicality, a cautious pause. But in reality, it is a high-stakes maneuver that reflects the complex economic and political cross-currents swirling both within the United States and around the globe. This choice is about more than numbers. It is about stability, risk, and the invisible levers that shape our daily lives. Let us unpack why this decision holds such significance, not only for the American people, but for citizens, investors, and leaders worldwide. To understand the Fed's actions today, let us step back into history. The Fed was established in the year 1913 in response to a series of banking crises that rocked the early 20th century United States. Its purpose was to create a more resilient, stable financial system, one that could weather shocks and support economic growth. Congress later gave the Fed its famous dual mandate, to keep prices stable and to promote maximum employment. In other words, the Fed is tasked with ensuring that inflation does not erode your purchasing power, and that jobs remain plentiful for those seeking work. It achieves these goals by wielding powerful tools, most notably the federal funds rate, the interest rate at which banks lend to one another overnight. Changes to this rate cascade throughout the economy, affecting everything from the rates on your credit cards and auto loans to the cost of financing a new factory or hiring additional workers. For more than a year, the Fed has been walking a knife's edge. Inflation, the steady rise in prices for everything from gas to groceries, has proved stubborn, refusing to fall to the Fed's ideal of 2%. At the same time, the broader economy is showing signs of fatigue. Growth is slowing, and warning lights are flashing in key sectors. Against this backdrop, in June of 2025, the Fed held its key lending rate steady in a range of 4.25% to 4.5%. This is the highest level Americans have seen in nearly 20 years, a sharp contrast to the ultra-low rates that prevailed following the global financial crisis and the pandemic years. But what does this mean for Main Street? These are not just abstract policy decisions. The impact is immediate and personal. Consider the average new car loan. According to data from Edmunds, borrowers are facing rates of around 7.3% on 5-year loans, the highest since the mid-2000s. 30-year fixed-rate mortgages are hovering just under 7%, a level that would have seemed unthinkable only a few years ago. For a family hoping to buy their first home, or for a business owner seeking to expand, these higher rates can translate to hundreds or even thousands of dollars in additional costs each year. For many, dreams of homeownership or entrepreneurship are being delayed or dashed entirely. This is why the Fed's every move is scrutinized, not only by economists and Wall Street traders, but by ordinary Americans and by politicians in Washington. The political stakes are enormous, especially in an election year. President Donald Trump has been especially vocal, blasting Fed Chairman Jerome Powell for not slashing rates more aggressively. In a particularly fiery exchange, Trump labeled Powell a stupid person, frankly, at the Fed, and even joked about appointing himself Fed chief. This kind of direct political pressure is rare in recent decades, as the Fed has long prided itself on its independence. But it underscores the stakes. Lower rates could potentially boost economic growth and ease the government's ballooning debt burden, while higher rates are meant to curb inflation but risk slowing the economy further. So why is the Fed holding the line? The answer is a tangled web of economic signals, political calculations, and global uncertainties. The Fed's preferred inflation gauge, the Personal Consumption Expenditures Index, is running at about 3%, still well above its 2% target. Meanwhile, the Fed's own forecasts have turned gloomier. It now expects gross domestic product to grow by only about 1.4% this year, a sharp downgrade from earlier projections. Unemployment, which had hovered near historic lows, is now projected to rise to 4.5% by year's end. Chairman Powell explained that the Fed needs more time to assess the impact of new tariffs, essentially taxes on imports from nearly every major trading partner. These tariffs, imposed by the Trump administration as part of a broader shift toward protectionist trade policies, are already raising costs for American businesses and consumers. Powell told reporters, "We will make smarter and better decisions if we just wait a couple of months." He emphasized that because the economy is still fundamentally solid, the Fed is well positioned to wait to learn more. In other words, the Fed is betting that patience will allow it to avoid either reigniting inflation or prematurely stifling growth. These debates are not happening in a vacuum. Recent economic data has been troubling. Retail sales, a key indicator of consumer spending, fell nearly 1% in May, suggesting that Americans are beginning to pull back on purchases. This is significant because consumer spending accounts for nearly 70% of the United States economy. Ivan Drury, a senior analyst at Edmunds, remarks, "Car buyers are struggling with affordability. The average new car payment has climbed to record highs, and dealerships are seeing more would-be buyers walk away, unable to afford the monthly costs." Meanwhile, Charlie Wise of TransUnion warns that even if the Fed does cut rates, the relief for credit card borrowers may be slow to materialize. Card issuers often react sluggishly to rate changes, and with many Americans already carrying record-high balances, any increase in monthly payments can tip the balance from manageable to overwhelming. On Wall Street, the Fed's stance is described as a high-wire act. Greg McBride of Bankrate paints a stark picture. Tariff-related uncertainty could unleash bigger economic shocks. Chris Zaccarelli, chief investment officer at Northlight Asset Management, notes that while the current bias is toward maintaining or lowering rates, the Fed is walking a tightrope between inflation that is too high and growth that is too slow. Some experts worry that the United States is flirting with a new kind of economic malaise. Joseph Brusuelas of RSM describes the situation as stagflation light, not the runaway crisis of the 1970s when inflation and unemployment soared together, but a milder yet still troubling combination of sluggish growth and persistent price increases. Even this lighter version, Brusuelas warns, can erode household wealth, discourage innovation and investment, and sap the nation's economic momentum for years to come. Yet, there are those who see glimmers of hope. Simon Dangoor of Goldman Sachs Asset Management argues that the recent uptick in inflation may prove to be transitory, a short-term spike driven by tariffs and supply chain disruptions, rather than a fundamental shift. If this proves true, the Fed's strategy of waiting could allow inflation to drift back toward its 2% goal naturally, setting the stage for future rate cuts and a smoother adjustment for households and businesses. But as Dangoor cautions, the timeline for inflation to cool is uncertain, and the risks of policy error remain high. The risk of a policy misstep is ever present. Byron Anderson of Laffer Tengler Investments warns that the Fed seems almost willing to sacrifice employment and GDP growth in order to keep inflation under control. This is a risky trade-off, especially as higher interest rates are already squeezing family budgets and business cash flows. If the economy stumbles, layoffs could accelerate, driving the unemployment rate, already expected to reach 4.5%, even higher. And with the federal government on track to pay $1.2 trillion in interest on the national debt this year alone, higher rates could crowd out vital investments in infrastructure, education, and healthcare, ultimately weakening the nation's long-term prospects. But the Fed is not acting in isolation. Global events have the power to overturn even the best-laid plans. Think about the possibility of further escalations in the Middle East, with conflicts between Israel and Iran threatening to choke off key energy supplies. A sudden spike in oil prices could reignite inflation pressures just as growth slows. Or imagine a major cyber attack that disrupts critical infrastructure, shaking consumer confidence and forcing businesses to halt operations. In each scenario, the Fed might be compelled to act quickly, possibly even reversing its current position overnight. History offers sobering lessons. In the 1970s, the Fed was widely criticized for acting too slowly, allowing inflation to spiral out of control and damaging the economy for years. In contrast, during and after the global financial crisis of 2008, the Fed was lauded for bold action that stabilized markets, but it also faced criticism for keeping rates ultra-low for too long, which some argue fueled bubbles in stocks and real estate. Today's landscape is arguably even more complex. Inflation is stubborn, growth is lackluster, and the political temperature is rising. The Fed must weigh not only the immediate effects of its decisions, but also their long-term consequences for financial stability and public trust. So, what does all of this mean for you? the average American household, the small business owner, the recent college graduate, or the retiree on a fixed income. Even if you do not follow every twist and turn of monetary policy, the Fed's actions touch nearly every aspect of your financial life. For homebuyers, the difference between a mortgage rate of nearly 7% and one of 5% can mean hundreds of dollars more or less each month, potentially determining whether you can afford your dream home. For car buyers, today's higher rates could add thousands to the total cost of your vehicle over the life of the loan. And for anyone carrying a balance on credit cards, even a modest change in rates can translate into more money spent on interest and less available for savings or discretionary spending. Charlie Wise of TransUnion cautions that even if the Fed does begin to cut rates, the impact on credit card rates is likely to be slow and modest. Card issuers are often slow to pass on lower rates to consumers, and with many Americans already burdened by high balances, any increase in monthly payments can spell financial trouble. For those living paycheck to paycheck, these incremental increases can quickly snowball into larger problems. Financial advisors are sounding the alarm on the need for caution and preparedness. David Kelly of J.P. Morgan Asset Management advises, "Do not hold your breath for lower rates from the Fed." He recommends that households and businesses build a financial buffer, set aside extra savings if possible, and think twice before making large purchases that could overextend their budgets. In periods of heightened uncertainty, having a cushion, whether in the form of cash savings or a flexible budget, can make all the difference when unexpected shocks occur. For investors, the path ahead promises to be volatile. Every new economic report, every statement from a Fed official, and every unexpected headline from overseas has the potential to send markets swinging wildly. Diversification, spreading investments across different sectors and asset classes, remains a cornerstone strategy for weathering market turbulence. Staying informed and maintaining a long-term perspective are equally important. As Jim Caron from Morgan Stanley Investment Management notes, we are moving toward a no-rate cut environment, and markets will need to adjust. Looking ahead, there are several possible scenarios. In the most optimistic case, the Fed's cautious approach pays off. Inflation gradually recedes, economic growth stabilizes, and the central bank can lower rates gently, achieving the elusive soft landing that policymakers dream of. This would allow families and businesses to breathe a little easier, with borrowing costs gradually declining and stability returning to the markets. In a less rosy scenario, the Fed's patience proves costly, and the economy slips into recession. Unemployment climbs, consumer spending falters, and business investment stalls. In the worst case, an external shock, such as a geopolitical crisis, a sudden surge in oil prices, or a cyber attack, forces the Fed to act abruptly, raising or slashing rates with little warning and throwing markets and households into new uncertainty. Fed Chair Jerome Powell and his colleagues are acutely aware of these risks. They have repeatedly emphasized their commitment to making decisions based on hard data and rigorous economic analysis, not political pressures. Powell has stated, "The Federal Reserve's rate-setting committee will make its decisions solely on objective and non-political analysis." Still, the pressure from elected officials and from an anxious public is relentless. Every decision is second-guessed, every delay scrutinized for hidden agendas. There is a deeper truth behind all the headlines and statistics. The Fed's choices are never just about numbers or charts. Behind every decision are millions of stories. Families deliberating whether to buy their first home, workers worried about the next round of layoffs, retirees struggling to stretch fixed incomes to cover rising costs. Your financial journey is intimately connected to the broader economic drama unfolding in Washington and around the globe. Consider how a single percentage point difference in mortgage rates can translate into tens of thousands of dollars over the lifespan of a loan, or how a spike in credit card interest rates can force families to cut back on essentials, reshaping household budgets and even educational opportunities for children. The Fed's cautious stance today is, in many ways, an attempt to balance these competing realities: the need to contain inflation, the imperative to support job creation, and the responsibility to safeguard long-term economic stability. As the summer of 2025 unfolds, it is more important than ever to stay alert, both to the headlines and to the state of your own finances. If you are considering a large purchase, carefully weigh your options and your timing. For those with adjustable rate loans, review your terms and consider locking in fixed rates where possible. Build up emergency savings if you can, and resist the temptation to overextend, even if lower rates seem just around the corner. If you are an investor, diversify your portfolio, keep an eye on global trends, and maintain a long-term perspective, rather than reacting to every twist and turn in Fed policy. Above all, remember that knowledge is your strongest defense in a world where a handful of decisions made in Washington can affect your financial future. Stay informed, ask questions, and join communities, like this channel, where you can access clear, unbiased analysis on the biggest stories shaping economics and technology. The world is changing rapidly, and the old rules do not always apply. Whether the Fed has played it too safe or shown wise restraint is a question that will be debated for years to come. What matters most is how you prepare, adapt, and make choices in your own financial life. If you found this deep dive valuable, hit the subscribe button and become part of our growing community. Share your thoughts in the comments. Do you believe the Fed's patience will pay off, or are they risking too much by waiting? We want to hear your stories and your strategies, and stay tuned as we continue to unpack the forces moving the global economy and the technologies shaping our future. In a world where a handful of decisions can change your financial destiny,